Hey, good morning, options traders. Happy Monday to everyone, and I hope everybody had a fabulous weekend. And I wanted to kick off the week with a really good question that I think will help every single trader in this group, especially the new ones, because I hear this all the time, and it is a fatal mistake. I've talked about it indirectly in previous videos, but I really wanted to drive home the point in this one. And the question is, would you pay $2 to make $6? And if you think about it, this is how most traders frame their trades, especially with vertical spreads. And they seem to think that if they can pay a little and make a lot, that somehow it makes it a good trade. And so the question is that a good way to frame your trades? How do you do it? Well, let's go find out more about it. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So, strategy decisions. Again, traders assess trades by cost versus the max gain. So, for example, a vertical spread, they might say, oh, I could pay 1 to make 4. Or I only use trades where I can pay 3 to make 5 or pay 1 to make 4. They have all of these different criteria that they use to say if it's a good trade or not. Well, the thing that you have to understand is that dollars are not the measuring stick. Dollars are outputs, and it's the probabilities that are the inputs. In other words, the prices are derived from probabilities, not the other way around. You don't say, well, the market gave it a certain price, and therefore the probabilities have changed to fit those prices. That's the whole reason that we use a pricing model. It's based on probabilities, and we can say, well, given the market prices, do they seem to be out of line or not? But we have to understand that we have a distribution of potential stock prices, those are the probabilities, and from there we can figure out the dollars. But if you're measuring things in dollars, you're on a wild goose chase. It will tell you nothing. Many of you have heard the expression from Warren Buffett, who said, price is what you pay, value is what you get. And this is what he was talking about. Yes, the market can set the price of a stock, but that doesn't really mean it's the value you're getting from that stock. Now, of course, theoretically, we should have a pretty good estimate if it's the market's assessment, but not always. We've seen bubbles, we've seen extremely undervalued or overvalued stocks on earnings. So you have to understand these are two distinct concepts. The price is something that we can set, just like the casino can set the price of the games. But the value that you get from it is dictated from the probabilities. So as options traders, think about it this way. Price is what you pay, but probability is what you get. And if you're not thinking in those terms, you're going to find out it can really lead you down the wrong path. So for example, let's say that we have a simple game. I'm going to give you a standard 6-sided die, and you can roll it, and if you roll a 1 to 5, I will pay you $1. And if you roll a 6, I will pay you $6. And for this fabulous deal, I'm only going to charge you 2. So this is a very simple probability distribution. We're saying there's certain probabilities to hit 1 through 5, and there's a certain payoff. Now notice I'm going to charge you $2. The maximum you could make is 6. So there we have it. This is a game where you can pay 2 to make 6. So therefore, by most trader standards, this should be a phenomenal deal. But as I'm going to show you, looking at things like this in terms of dollars reveals absolutely zero. It's just simply the price. These are outputs. We have to understand what were the inputs. Were those the proper inputs to give us these outputs? Well, let's go find out. This is an easy one to figure out. We know that to roll a 1 through 5 will happen 5 out of 6 times. So take your calculator, take 5 divided by 6, multiply it by the reward of $1. And then add it to 1/6 of the time that you will land on 6. We add them together, and you get $1.83. And what this is called is the expected value. If you were to do this hundreds or thousands of times, you should pick up about $1.83 on average per roll. And therefore, it should cost you $1.83. But what did I say the cost was? Cost is 2. So if you're paying 2, you have a negative edge against you of 17 cents. That's even worse than roulette. So when we look at it through the lens of probability, this is something you don't want anything to do with. But yet, if we measure it in dollars, what do we see? Oh, I can pay 2 to make 6. It must be a great deal. Do you see the problem there? It's not a great deal. It's horrible. And that's why it's a bad, bad mistake to measure things like this in terms of dollars. We need to know how those dollars got there, not the relationship to the dollars and saying, therefore, they reflect the probabilities. That's working the problem backwards, and it's very dangerous. So here are some simulations in Excel. Here's 5 simulations of 1,000 rolls each with this game, where you're paying $2, and then for the numbers 1 through 5, you win $1, or for the number 6, you win 6. So once again, you're paying 2 to make 6. Sounds amazing. There's your results. Absolutely a losing game. You will never win that in the long run. So what's the thing to take from this? Dollars tell you nothing. Probability says everything. Now, to make the point even stronger, let's try a different game. We'll take the same die, and I'm just going to change up the probabilities a little bit. Now I'm going to say if you roll a 1, you get $1. If you roll a 2, you get $2, and so on. Your payoff is simply the number that you land on. So again, you can't lose. The lowest you can earn is $1. The maximum you can make is 6. We're going to make the cost 2. We'll keep that the same. So once again, you can pay 2 to make 6. Must be a fabulous deal if we're going to look at it in terms of dollars. But we shouldn't do that. Why? Because let's look at the probabilities. 1/6 of the time, you're going to roll a 1. 1/6 of the time, you'll roll a 2, and so on. We multiply these out, add them up, and we get 350. So this means that on average, you're going to earn $3.50 every single time you roll the die. But I'm only charging you 2. So now you have a positive expected edge, or a positive value of $1.50. So, hey, bring it on. Roll that die as many times as you can. And yet we could still say the game is pay 2 to make 6, and therefore it's a great deal. And this time it is a great deal. But not because it's pay 2 to make 6, but because of the distribution. It's because of the probabilities. So here's another simulation, 5 tries of 1,000 rolls each, and look at the difference. Big difference from the last one. In fact, if you look at this, there's not as many zigs and zags in it. Pretty straight line, especially compared to that first chart. And the reason is you've got a massive positive value. It's going to be really hard to lose even in the short run down here. Look at this. We started almost at 0. Never went below 0. The only time you could go below 0 is if you roll a 1. You get a $1 payoff, but you paid 2. If you roll a 2, you're just going to break even on that roll. So the only time you're going to dip below 0 is if you roll a streak of 1s. And of course, that's going to be unlikely. So you can see almost no chance of even going negative. And look at that thing go. And yet, we could describe the game exactly the same as the first, that it's pay 2 to make 6. And yet we get radically different outcomes and radically different decisions when we look at it through the lens of probability. So the thing to get from this video is to think about probabilities. Consider the chances for the stock to reach certain levels. In future videos, I'll show you some little tips and tricks that you can do that without getting too complicated. But for right now, I just want to make sure that everybody understands that measuring trades as pay 2 to make 6 is just a really bad idea. Why? Because dollars tell you nothing, probability says everything. Think in terms of the chances for various profits, and you'll make better decisions. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.